We just had a massive 2 weeks of earnings. I want to do a quick review of some important companies that reported over the last 2 weeks and give my take on each, providing if I think they are a current buy or not. Also, some important takeaways and much more. So, we're going to get right into this, and we're going to start with Tesla. Looking here, Tesla did not do well. Their free cash flows are going down. Their revenue decreased year over year. Their long-term debt is going up, and their net income is declining. All these numbers are going in the wrong direction. And if we look, their total automotive revenues went down year over year by 13%. Now, despite all this negative, the stock did go up after earnings due to the fact that Musk is cutting headcount by 10% and looking to accelerate new models, including less expensive vehicles that could be ready by early 2025, if not before the year end. So investors are thinking and hoping that this will spark new purchases, a lot of new purchases of Tesla's cars in the near future. Not only that, a few days later, the stock did go up again after recent news that Musk wins China's backing for Tesla's driver assistance service. Now, this is a step forward for Tesla's ambitions in fulfilling their long-term AI and autonomous driving. China is the world's biggest car market and Tesla's second biggest market. Tesla did manage to clear two of the most important hurdles. That's reaching a mapping and navigation deal with Chinese tech giant Baidu and meeting requirements of how it handles data security and privacy issues. This could be a golden opportunity for Elon, but his market share of EVs is shrinking in China, and I'm not so confident in their government due to the strained relations with the US, so I just see as much risk as reward here. I personally still see Tesla as just a car company, as most of its revenue does come from the automotive segment, and I would not buy its stock at this point, even with this news. I'd rather wait to see it play out and see if it successfully does so. Regarding autonomous driving, I see Waymo, which is Google's subsidiary company, with an advantage due to all its data it has at its fingertips, and it could be a fierce competitor to Tesla. It is just hard for me to invest in a company that relies on most people taking out debt to buy its products. It is a cyclical business and one that will swing heavily with the economy's health. Let me know your thoughts though if you are buying or avoiding. Next up is Meta. They had good earnings. Their free cash flows went up massively, revenues going up year over year, long-term debt remained flat, and net income is going up as well year over year. Now, the stock dipped despite these good earnings as Mark Zuckerberg had to open his mouth and he heavily talked about the ways that Meta loses money. So obviously investors don't like hearing that. I don't know why he did that. Maybe he's wanting to buy back shares and make sure the stock goes down so he can do so. But if we do look at some highlights, we'll see that their family daily active people went up and increased 7% year over year. As big as this company is, they're still finding people that are joining quarter after quarter. That's impressive. Now, ad impressions. This is a very important part of this company's business. Increased 20% year over year, and the average price per ad went up 6% year over year. Now, revenue increased 27% year over year. That's incredible. And the headcount decreased 10% year over year. So he's focusing on that efficiency still. Overall, I see a company with huge AI potential that will remain an advertising powerhouse for the foreseeable future. Mark is still fixated on the metaverse, and that has yet to play out. I'm not fond of social media companies as I see it as a popularity contest, but with TikTok's recent ban, this could prove beneficial for Meta. Overall, I do think the company is a buy. It's just not for me, but let me know what you think. Up next is Microsoft, the mighty Microsoft. Now, their free cash flows went up, the revenue went up, the long-term debt did go up year over year, but overall it's on a downtrend over the last 2 years, and net income did go up year over year as well. Some great numbers that we saw. Now, some highlights from their business are that their revenue and productivity and business processes increased 12%. Their Office commercial products and cloud services increased 13%. Their Office consumer products and cloud services increased 4%. LinkedIn revenue increased 10%. Dynamic products and cloud services revenue increased 19%. The revenue in intelligent cloud increased 21%. And most importantly, the Azure part of it increased 31%. That is phenomenal and above expectations, which were about 28.5%. Now keep in mind, last quarter, Azure growth grew 30%. So it's accelerating, and now it's growing at this last quarter 31%. That is phenomenal. This is a big part of this company's revenue, its future. It has great profit margins and will be a great driver of cash flows. Now, revenue in more personal computing increased 17%. Windows revenue increased 11%. The only area that decreased was devices. This is something that has been on the decline though over time, and it's a small part of the business, so nothing to be worried about. Xbox content and service revenue increased 62%, but you have to put that in perspective as 61 points of the net impact came from the Activision acquisition. Also, the search and news advertising revenue increased 12%. This is the part where Microsoft is trying to go after Google search. So it's growing, that's great, but has a long ways to go. And Microsoft returned $8.4 billion to shareholders in the form of share repurchases and dividends. Also, the CFO said currently near-term AI demand is a bit higher than our available capacity. So not only do you have Azure accelerating growth, but you have this huge AI demand with Microsoft. I have said this for a while, but I think Microsoft will be one of the biggest winners when it comes to AI, and we are seeing that demand already. Very exciting as an investor in Microsoft. Now, Microsoft continues to outperform for such a large company, and I don't see that changing anytime soon. For me, this company, though slightly overvalued, is a buy for the long term. Would you buy Microsoft at its current valuation? Let me know. Next up is S&P Global. We'll see free cash flows went up year over year. Revenue went up year over year. Long-term debt is trickling down slightly. You see that jump in that 2Q of 23. That was from an acquisition. And net income is increasing year over year as well. So good results overall. And if we look at its segments, we'll see market intelligence revenue went up 7% year over year. Ratings, the thing that it's known for, one of the biggest parts of its business, went up 29%. That is fantastic. Commodity insights went up 10% year over year. Mobility went up 8%. Indices went up 14%. Overall, revenue went up 10% year over year. This company raised its full year guidance, hit record revenue numbers, and announced additional share repurchases through third quarter of 2024. A company I think will benefit from AI as it is a data powerhouse and one I definitely think is a buy for the long-term investor. Nothing to see here, business as usual, which is what I like. Let me know if you saw anything different with their earnings. Now, Google, they had quite a big earnings. Now, free cash flows did go up year over year, so did revenue, long-term debts going down, and net income went up pretty nicely year over year. So great numbers. And if we look at the different segments, you'll see just how much growth happened here with Google search going up massively, YouTube ads going up nicely. Overall, Google advertising is doing really well. We also have subscriptions going up. Google Cloud is doing really well. So the cloud businesses in general are doing great. Total revenues just went up very nicely. So it was a big earnings from Google. They're another AI winner, but for me, they're just behind Microsoft. I think Microsoft is in first place, but they will still be an AI powerhouse of a company. I think Microsoft's Copilot just got off to a stronger start and propelled it into a more popular used AI tool by consumers than Google's Gemini. In fact, I only know people that use Copilot, including myself, and I don't know anyone that uses Gemini. On top of that, Google holds so much cash, they decided to start paying a dividend. This was the big news, and that amounts to $10 billion annually, but in perspective, it is just a 0.12% yield at its current stock price. But if you bought and held this stock for years, your yield could be above 3%, so be sure to check that out. This is the second big tech company to start paying a dividend, the other being Meta. So great earnings, and I think Google is a buy. My hesitation in the past was that most of its revenue came from search, but I think their search business in itself has a wide moat. This may be a stock that I buy someday, we shall see. Let me know what you thought of Google. Next up is Union Pacific. Now their free cash flows did decline year over year. The long-term debt is kind of remaining flat the last 3 quarters. Net income did go up ever so slightly. So really nothing that really wowed investors. But if we look at their operating performance, we will see that their reportable personal injury and reportable derailment rates both improved. So that's a good thing. The quarterly freight car velocity had a 4% improvement. Quarterly locomotive productivity had a 10% improvement. The maximum train length had a 1% increase. Workforce productivity had a 1% improvement, and the fuel consumption had a 1% improvement. So overall, these are slow improvements, but they're improvements nonetheless. And profitability outlook is gaining momentum with strong service product, improving network efficiency, and solid pricing. And that efficiency is what Union Pacific needs to focus on in order to provide us this investment that will grow. They're also restarting share repurchases in the second quarter, which should really also help the stock appreciate. So it's not a sexy company, but one with an extremely wide moat, providing a necessary service, and is positioned for improvement, which we are starting to see in its earnings. I forecast a more efficient and financially robust company in the future, and one I have no problem keeping in my portfolio. I do think this is a solid long-term buy. Let me know if you are invested in this company or any other railroad company and your thoughts. Then we have Amazon. I just love this company. Look at those free cash flows. They went from the negative 30 billion 2 years ago to now 50 billion. That's an 80 billion swing in just 2 years. That's crazy. Revenue went up year over year, long-term debt's going down, and net income increased year over year. So if we look at its different segments, online stores went up 7%, physical stores went up 6%, third-party seller services went up 16%, advertising services, which I think is the most important thing right now with Amazon, went up 24%. Very good to see. Subscription services went up 11%. I love seeing this in the double-digit range. Amazon Web Services did fantastic. Another cloud business doing great. It went up 17%. Then it has other at 23%, but it's such a small part of the business. Now, CEO Andy Jassy contributed AI as the reason for Amazon Web Services' reacceleration of growth. Again, AI comes into play in the growth of cloud and the business in general, like it did for Meta, Microsoft, and Google. I think we are seeing the beginnings of a new tech driver of growth. Don't sleep on AI and make sure you are capturing it in one way or another. So really, the only disappointing news, if I had to pick something, is that they did not choose to pay a dividend like some of the other tech companies such as Meta and Google, but I think they will eventually. They decided instead they're going to focus on paying down their debt, which I am totally fine with. Amazon is definitely a long-term buy for me. Let me know your thoughts on Amazon. I absolutely think they will outperform for years to come. Next up is Vici, the REIT that I think will outperform 90% of other REITs, and this proves it here. Their earnings showed that their AFFO is growing, their revenue's growing, long-term debt remains flat, and again, REITs operate on leverage, so you have to remember that. The fact that they're not increasing debt in this high-rate environment is super important. Net income also is growing year over year, and the AFFO per common share is on this nice steady increase. I doubt you'll see numbers like this from other REITs, but let me know if you see any outperforming Vici. I'd love to look into them. But if we look at some highlights, again, the AFFO attributable to common shareholders increased 10.3%, and on a per share basis, it increased 6.1%. The other thing that I want to mention is they have a $700 million investment that they're funding exclusively to the Venetian resort for reinvestment projects. So essentially, Vici is loaning the Venetian this money to improve its resort and will repay Vici by increased rent amounts. This proactive approach on property management not only ensures the long-term competitiveness of Vici's assets, but also presents opportunities for increased rental income and asset appreciation. The strategy's focus on value-enhancing investments aligns with the company's tenants' efforts to build guest loyalty and drive consumer value, creating benefits for both parties. A very smart move. I love this REIT and think, again, it will outperform 90% of other REITs over the long run, so it is why I'm so bullish on it. It's absolutely a buy currently. Then we have Apple. Now, I don't have their free cash flow data just yet, but I can tell you it probably went down from last quarter, but still increased year over year. I will pin that in the comments when I do get that data. But revenue did decline year over year. Long-term debt is going down, and net income also declined year over year just slightly. So even though there wasn't much to expect from Apple this quarter, they still beat estimates, but it's not all rosy in my eyes. There was a 10% drop in iPhone sales year over year, the largest since the pandemic. Why is this? Well, other than a tougher economy squeezing consumers' pockets, I think it's a lack of innovation and pressure from China's recent successful offerings with their tech companies. But this could be a wake-up call, and maybe we might actually get some bigger jumps in new features and innovation. I guess we shall see. Now, this stock is doing well, not only because it beat estimates, but it also announced a 110 billion stock buyback plan that is the largest in US history. This will definitely boost the stock price up. And it also announced a 4% increase in its dividend. So this company just has a ton of cash. It's really not growing with its revenue and business in general as fast as it would like. So what's it going to do? It's going to return that to investors. It's going to share those profits. And that is what investors like to see. So that's helping promote the stock and the growth that it's seen since its earnings. Now, of course, Tim Cook boasted about future AI plans, another earnings where AI was front and center. I say to stay cautious with Apple. I think it's a buy for the long term investor, but it may be one that returns less than Microsoft or Amazon over the next 5 years, 5 to 10 years probably. So there you have it. 9 big earnings, most in this portfolio. You'll see Microsoft, Amazon, S&P Global, Vici, Union Pacific. Real estate is making a comeback. Of course, my overall growth now is above 19%. Just my last video, it was in the 16% range. That's also boosted by technology kind of having a boost this week. So let me know if you have any questions. I share this with every video. I'm very transparent. Also, let me know what you took away from these earnings. I took away still a robust economy, AI dominating the tech space, and solidification in the companies I'm invested in. I love these big earnings weeks. That's just the investing nerd in me. Be sure to share if you bought or sold any more of these companies due to their earnings results. I personally am waiting for my buy price targets I set and shared in my last video, so we'll see if any hit so I can buy. Thanks for joining me today. I appreciate all of you. And with that said, happy investing, and we will see you soon on Mark Arnold's Finance.